Welcome students. In today's session we will be doing economics unit 1. So this chapter is about gross domestic product and its growth and introduction. So gross in general, it's otherwise we can call it as total. So domestic is within the country, so that is it. Product is, when you buy something we call that as a product. So we are going to learn about that, which is in short known as GDP. Gross is G, domestic is D, product is P, GDP. And if you turn on your television now during this pandemic time, we see many people talking about this word, GDP. Okay, so let's learn about that. So first we have introduction. To understand how the GDP tells us how India is going, you should understand what GDP is. So for that, imagine what happens in a hotel. You place an order for 2 idlis and a cup of tea. Someone makes the idlis and tea and someone else serves you. So I hope we need not have any explanation for this. So you go to a hotel, you place for 2 idlis and a cup of tea. So there's one person making idli and tea, but there's another person who comes and serves it at your table. Idlis and teas are produced. So the word produced, that means it is made. Okay, these are tangible. Tangible means things which you can touch and feel is called as tangible. So idlis you can touch and you can feel it is soft. Economist, that is people who talk about money, study about money values, call such tangible items as goods. These goods are not free but have to be paid or to be paid. So whichever things that you can touch and feel are called as goods, and for those goods you have to pay money. Though you don't realize it, in addition to these tangible things called goods, something else is being produced. So apart from these goods, there are something else that is being produced. The work done by the cooks and the people who serve the food. So what is that extra that we are going to learn here is what work is done by the cooks inside the kitchen and the people who work to serve it on the table. The activity of cooking and serving is not something you can feel and touch. So whatever cooking is being done, you cannot feel and touch it, and you cannot feel what the server does when he comes to the table. Such activities are non-tangible but are nevertheless crucial for you to enjoy the food. So those things that you can touch and feel are called tangible and they are called as goods, and those things which you are not able to feel and touch are called as services. So economists call such activities as services. So two important words we learn here. Goods are things that you can feel and touch, that is goods, or we call it as products, whereas the activities that are done which you cannot feel and you cannot touch are called as services. What happens every day in a hotel at nationwide? Goods and services are produced and paid for, and this what the GDP measures. So what does GDP measure? So gross domestic product, what does it measure? It measures goods and services that are produced and how much you need to pay for it. So that's the first part of it. Then definition of GDP, a very important term here. The GDP is the market value. So we must know what is market value. The price which you pay while you are putting it up or selling it up in the market. The price that you have to pay for. Okay, that is called as market value. The GDP is the market value of all the final goods and services produced in the country during a time period. So this is a definition for GDP. So it is the market value. Market value means it is the price for the final good that you receive and the services that are produced in a country during a time period. So that we need to have a formula. Whenever we want to measure something, we need a formula. So GDP is C plus I plus G plus X minus M. So each term has a value there. C is consumption. Consumption is how much you take in is called as consumption. I is the investment. So for doing a goods, for doing a product, you need some money to be invested. So that is called as investment. G, government expenditure. So government will put some taxes and all that, right? So that is called as government expenditure. Expenditure means selavu. X minus M, X is exports, M is imports. Okay, every part of the definition is important. So that part of the definition you should know. Goods and services. Already let me tell you, goods means that which you can feel and touch. Services are activities which you cannot feel and touch. As you know by now, goods are tangible items. Tangible means which you can touch and feel, while services are activities which are intangible. That means you cannot touch and feel. Market value. This is the price at which goods and services are sold in the market. Final goods and services. Economists Tyler Cowen and Alex Tambarock say that final goods and services are the goods and services which will be used or consumed. So these two economists, Tyler Cowen and Alex Tambarock, they said final goods and services are the goods and services that people will be using or people will be consuming. The goods and services which will be used for producing other goods and services and will form a part of the goods and services produced are called intermediate goods. So intermediate means something that is in between. So before we produce a product, a final product, certain products will be involved in between. Those products are called as, those goods are called as intermediate goods. So generally here when we say goods and product, product is the outcome, goods are the things that you use. Only the final goods are included in the GDP. Intermediate goods are not counted in calculating the GDP because their value is included in the final goods. So there are two types of goods, final goods and intermediate goods. So whose value will be taken is final goods value, GDP will be taken. Intermediate goods price will not be taken because that will be added in the final goods price. So if the intermediate goods are included in the GDP, it will result in what is called as double counting. Now we are going to understand this now. For example, a cup of tea bought in a hotel is a final good. Imagine you go to a hotel and you buy a cup of tea. Now what is that good that you brought? Cup of tea, which is called as your final good. Because it is consumed. So who's going to drink that tea? You are the person. So it is being consumed and does not form a part of producing something else. So the market value of the cup of tea being a final good is included in the GDP. So that tea that you have bought right now, the value of that tea will be included in the GDP because it is the final good. Whereas sugar which is mixed in the tea, now sugar is also a good, right, but it is already mixed in the tea, is an intermediate good because it is used in making tea and forms a part of the tea that is served. So this sugar is used, but it is not the final good, it is the intermediate good. Suppose the tea is priced ₹10 a cup, of which the value of sugar used is 2. So the price of the cup of tea includes the ₹2 price of the spoon of sugar. So this I hope you understand. So tea total price for that tea is 10 rupees and 2 rupees is for sugar. So this 2 rupees which you have which is there for sugar is already included in that 10. So the total price will be 10 only. If the value of sugar is included in the GDP, it will be counted twice. So if you are going to add that in the GDP, what will happen? Already final good it is 10. Now for sugar, if you are going to add it extra, it will become 12. So intermediate good price will not be added. And this is double counting, and to avoid it, the intermediate goods like sugar are excluded from GDP. So intermediate good price will be excluded. National income. So this part of your PDF is a little blurred. I hope you can understand. National income is a measure of the total money value of goods and services produced by an economy over a period of time, normally a year. So we are learning a new word here, national income. National means country. How do we take in a country's income? Income is what they get, okay, the earning. So it is the measure of the total money. So if you want to find the total money in a country because of goods and services produced by an economy. Economy means money over a period of time, which is normally 1 year. Commonly, national income is called as gross national product, GNP. This is a different one. What we learnt previous is GDP, gross domestic product. Here it is GNP, which is gross national product, or the other name for that is national dividend. Now what are the various terms associated with measuring of national income? So how can we measure, how can we find out, measure means find out the national income, the country's income. First one is gross national product, which is GNP. Just now we studied. It is the total value of goods and services produced and income received in a year. This is how much of goods and services a country is producing, and through that how much of income they are receiving in a year by. So who has to give money for all this? Domestic residents. Domestic means that country people have to give. That is called domestic residents of a country. It includes profits earned from capitals invested abroad. So here you can also this income, if say for example the country has put some capital abroad, outside in the world, and from that they get profit, that will also be calculated in the national product, gross national product. Formula for that is GNP equal to C plus I plus G plus X minus M plus NFIA, where C already we have learned consumption, I is the investment, G is the government expenditure, X minus M is export minus import, NFIA is the net factor income. Net means total income from abroad. Abroad means from the world. Next one is gross domestic product. So first one is we saw how a country can gain income by gross national product. Now it is gross domestic product. Gross domestic product is the total value of output of goods and services. There we saw by the income that we get, here by the output that we give out of goods and services produced by the factors of production within the geographical boundaries of a country. Next one is net national product. Net national product is arrived by making some adjustments with regard to depreciation. That is, we arrive the net national product by deducting the value of depreciation from gross national product. So if you can see the last line, NNP is net national product. How to calculate this net national product? First you should know the gross national product, that is GNP. From that product, that gross national product income, if you subtract the depreciation, depreciation is in Tamil we call Teimanam. So when we start using a product, what will happen is after few years it will not cost the same price. Say for example you buy a chair which is for 1000 rupees. Maybe after 4 or 5 years, can you sell that chair for the same 1000 rupees? No. It's already maybe the top part is varnish is gone or it is shaky. So what will happen is you will have to sell it at a less price. That price is called as depreciation. Net domestic product, which is NDP. So net domestic product is a part of gross domestic product. Net domestic product is obtained from where we get net domestic product, gross domestic product by deducting means subtracting the quantum of tear and wear expenses, that is what is called as depreciation. Quantum is the total. If you subtract the total tear and wear, tear is teimanam, tear and wear expenses, then you get what is called as net domestic product. If you look into the last line, NDP, what is NDP? Net domestic product. How can you obtain that? By gross domestic product, that is GDP minus, that is what we use the word deducted, depreciation. Okay. The next one we move on to per capita income. Per means right? Per capita income or output per person is an indicator to show the living standard of people in a country. So, in a country, each individual will be earning some money and they will be spending some money. That is called as per capita income or output per person. It is obtained by dividing the national income. So, how to find what is the standard of each individual in a country? If you find the national income of the country and if you divide it by the population, you will get per capita incomes. Okay, you understood that. So, if you want to find what is the average value a person, average money a person is earning in India, that means what you have to know? You have to know how much India is earning totally, and from that if you divide the population, you will get what is the income for each and every individual. In 1867 to 68, for the first time, Dadabhai Naoroji had ascertained the per capita income in his book Poverty and Un-British Rule of India. So, he was able to find out or talk about this per capita income when in the year 1867 to 68. Personal income. So, it is the total money income received by individuals, by every single person and household of a country from all possible sources before direct taxes. So, before a person can pay his taxes, if you calculate what is the source of income, then that is called as personal income. Disposable income. Disposable income means actual income which can be spent on consumption by individuals and families. Thus, it can be expressed as DPI, which is equal to PI minus direct taxes. So, now here you have to understand what is PI. It is the personal income. What is here DPI, disposable income, is we have personal income minus direct taxes. Next we move on to gross domestic product. Again we are going to learn in detail about this GDP. Produced in a country. Okay, how to calculate the gross domestic product GDP which is produced in a country. GDP of India includes only the market value of goods and services produced in India. So, if you want to find what is the GDP in India, that means you have to find out the goods and services India is producing. For example, the market value of apples produced in Kashmir are included in our GDP since Kashmir is in India. So, if you take apples that are produced from Kashmir, I can give a value for that because Kashmir is inside India. The market value of apples produced in California, even if they are sold in Indian markets, they are not included in our GDP because California is in which place? It is in US, it is in America. So, we cannot take that income into account. Produced during a time period. The GDP of a country measures the market value of goods and services produced only during the specific time period. So, the product and the goods that you get should be produced during that specific time, which is generally 1 year. The goods and services produced in earlier periods are not included. In India, the GDP is measured both annually and quarterly. So, if we find out the gross domestic product GDP of India, we do it in two types. One we find it annually once in a year, or sometimes we do it 3 months once. Quarterly is 3 months once. The annual GDP is for a financial year. So annual means for a year. So it starts from April 1st of one year to March of the next year. The modern concept of GDP was first developed by Simon Kuznets for a US Congress report in 1934. Now this is again a very important part, methods of GDP calculating. So how will you calculate the GDP? How will you find out the GDP? First one is expenditure approach. In this method, the GDP is measured by adding the expenditure on all the final goods and services produced in the country during a specified period. So the word itself tells you expenditure. Expenditure means selavu. So for all the goods and services that the country has produced, if you are going to find out the expenditure and add up everything, that will give you the expenditure approach. So y equal to C plus I plus G plus X minus M. We all know that term. C is consumption, I is investment, G is government expenditure, X is exports, M is import. The income approach. This method looks at GDP from the perspective means from the view of the earnings. Now that first one is from the expenditure we are going to learn. Here it is going to be the income of men and women who are involved in producing the goods and services. So if you are going to calculate the income got by men and women in producing these goods and services, that will give you the income approach. The income approach to measuring GDP is how to find out y equal to wages. Wages is the money that you pay for some work done is called wages, plus rent plus interest plus profit. Okay. So wages plus rent plus interest plus profit. Value added approach. A cup of tea served to you in a hotel is a final good. We already know that. The goods used to produce it, what are the goods that you will use? Tea powder, milk and sugar are called as what? Intermediate goods. Since they form a part of the final good, the cup of tea. One way to measure the market value of the cup of tea. So how to find the market value of that cup of tea? You are going to add the value produced by each intermediate good used to produce it. So you have to find the value of tea powder, you should know the price of milk, you should know the price of sugar. And if you add all the three, that will give you the cup of tea price. The sum means total. The sum of the value added by all the intermediate goods used in production gives us the total value of the final goods produced in the economy. Now you can see this chart here. So the tea is your final good. There are three intermediate goods: tea powder, milk, sugar. So if you add the price of tea powder with the price of milk with the price of sugar, that will give you the price of tea. So that you have to keep in mind. Next one is value added method. Okay, so that is tea powder plus milk plus sugar equal to tea. Importance of GDP. A very important question here. Why is GDP to be calculated for a country? You can study the economic growth. Economic means money growth. So if I want to know how far India is developing, then I should know the GDP value. Problems of inflation and deflation. Is there money value? Is the money value increasing? That is inflation. Deflation is if the money value is decreasing, that is deflation. So you can study that. If you study GDP, you will know whether we are having any problems. Comparison with developed countries of the world. So you can compare whether India is in power with other countries in the form of economy. Estimate the purchasing power. So if India has got a good GDP, that means it can purchase more things from the outer world. Study of public sector, you can study. Guide to economic planning. So people can plan their money. Okay, the country can plan how to improvise on it. So country has to study GDP. Limitations of GDP. So limitation is why you should not why you should limit yourself to GDP. Several important goods and services are left out of the GDP. So the few goods are not included in the GDP. The GDP includes only the goods and services sold in the market. The services provided by parents to their children is very important, but it is not included in the GDP. So the activity that your parent does for you is not included because it is not sold in the market. The activity is within your house, so it is not sold. Likewise, clean air, which is vital is important. For a healthy life, it has no market value and it is left out of GDP. GDP measures only quantity but not quality. So what does GDP find out? It measures only quantity, the amount, but not the quality. Quality is there. In 1970, schools and banks did not permit the use of ballpoint pens. So if you know, in 1970, children were not allowed to use ballpoint pens. Even now we don't allow. This is because the ones available in India were of very poor quality. So those days ballpoint pens were of poor quality. Since then, not only has there been a substantial increase in the quantity of ballpoint pens produced in India, but their quality has also improved a lot. So after that, what happened is people worked on both quality and quantity. The improvement in quality of goods is very important, but it is not captured by the GDP. GDP does not tell us about the way income is distributed in the country. Now we are getting income, but how it is spent in the country, we don't know. The GDP of a country may be growing rapidly, but income may be distributed so unequally that only a small percentage of people may be benefiting from them. So GDP is growing, but the income that we get is not equally distributed. So only a part of the people are getting benefited. That's what they are trying to tell you. The next part of it is the GDP does not tell us about the kind of life people are living. A high level of per capita real GDP can go hand in hand with very low health condition of people, an undemocratic political system, high pollution and suicidal rate. So what happens is when your high level of per capita income GDP goes hand in hand, there could be low health conditions of people, political system will go undemocratic, and high pollution rates will be there and suicidal rates also. Estimation of GDP. The Central Statistical Organization CSO under the Ministry of Statistical Department keeps the records. Its processes involves conducting an annual survey of industries and compilation of various indexes like the index of industrial production, consumer price index, etc. So this is extra information where the Central Statistical Organization CSO, which is under the Ministry of Statistical Department, this keeps records of the GDP that's happening in a country. The next one is composition of gross domestic product. So composition, say for example, that is the levels in which you can measure gross domestic product. Okay, that's called as composition. So here we can check. Indian economy is broadly divided into three sectors. So here first one is the primary sector, which is the agricultural sector. You already know India is an agricultural land of country. So our main source of income is from agriculture. Agricultural sector is known as primary sector, in which agricultural operations are undertaken. Agriculture based allied activities, that means agriculture is also supportive of certain other industries. Raw materials are needed such as cattle farm, fishing, mining, forestry, corn, coal, etc. They also come under agricultural operations. Secondary, that is industrial sector. Industrial sector is secondary sector in which the goods and commodities are produced by transforming the raw material. So, whenever we get a raw material, when we change it into another product, we need industries. Important industries are iron and steel industry, cotton, textile, jute, sugar, cement, paper, petrochemical, automobile and other small scale industries. Then tertiary means third. Tertiary sector is known as service sector, which includes all the government sectors, scientific research, transport, communication, trade, postal, telegraph, banking, education, entertainment, healthcare and information technology. So, all that which includes your individual local people are called as tertiary sectors. And then in the 20th century, economists began to suggest that traditional tertiary services could be further distinguished from quaternary and quinary service sectors. So, in the end of 20th century, they said that tertiary services, that means these service sectors can be separated into quaternary, means 4 order or 5 order service sectors. The next one is contribution of different sectors in GDP of India. So, service sector is the largest sector of India. Gross value added at current prices for service sector is estimated at 92.26 lakh crores in 2018 to 19. So, what is the gross value added price for service sector? Totally we get an income of 92.26 lakh crores. Now, you can see one big chart being given to you. You can go through that and see how much of percentage we get from GDP by calculating GDP. Agricultural sector, which is in blue, you can see it is 15.87. all that you can just go through, it will give you some information as well. And then we move on to India is the second largest producer of agricultural products. So, India agricultural products, we are the second. India accounts for 7.39% of total global agricultural output. So, we are second in producing agricultural products, and output, how much we give out is 7.39% we give out to the world. In industrial sector, India's world rank is 6. So, in industrial sector, we stand 6th in the world, and in service sector, India's world rank is 8th. We stand 8th in the world. Contribution of agricultural sector in Indian economy is much higher than world's average, which is 6.4%. That means, from agricultural sector, Indian economy is benefited by how much? It is 6.4% when compared to the world. Contribution of industry and services sector is lower than world's average, which is 30% for industrial sector and 63% for service sector. So, here it is with relative to world's average. So, contribution of industry and services sector is lower. Here world's average is 30% lower and 63% lower. So, now here we can gross value added, which is GVA. Just now we studied that word. It is the measure of the value of goods and services produced in an area or in an industry or in a sector of an economy. So, if you find the value of goods and services that is being produced in one particular area or in one particular industry or in one particular sector, that is called as gross value added. So, which is GVA equal to GDP, gross domestic product, plus subsidy. Subsidy is like the government, now you know this for cylinders that we get at home, government provides subsidy because they want to bring down the price of cylinder, so it is accessible for all the local people. So, the government gives some money to lower the price of such services, that is called as subsidy, minus direct sales tax. So, that is gross value added, which is GVA. So, go through the lesson.